Well, welcome to this video. JD here. I just wanted to, before the year ends, talk about my method to trading for 2020, which it's a compilation of my various methods that I have traded in the past 10 years. And I've come with this method that takes them all and put them all into one method that it's going to be easier, and it's been easier to trade, and also it's more direct, as I should say, using levels, beep levels, and using also pitchforks and trend lines. So I hope this video helps someone into trading for 2020, and I'm certain that if you do this correctly, you could find a way to be stable and profitable if you control your emotions and if you have very good control of the trading regarding money management. So let's start to talk about this method. First of all, we really need to establish the open price, and as you can see here, it's been is that green dotted line called with this tag reg open. That means regular open. Okay, so as soon as we establish that, we want to understand if the price goes up the open, if the price goes up the open, or the price goes down the open. Okay, so that price happens right at the market open, and we're talking about 8:30 my time. That's gonna be 9:30 Eastern time, and 8:30 Central also. Since we're trading the Nasdaq, that's a very important thing about the timing. So as soon as you have that set, that price, by the way, I'm trading with Renko charts right here. As you can see, that's the combination trend of 3, a reversal of 22, and an open of 12. As you may know, Renkos are very helpful to establish trend, and is nothing else than I can show you my indicators here. So I have set the Heikin-Ashi on top of that Renkos, and then a sort of indicators that help me to come to this end, to this looking chart. So the very first important thing that I want to mention is about the open. Okay, so price, we need to establish that opening price, and we want to know if the price is going above that open or going below that opening price. That's key. That's key, because as you will see, and you can also review your charts from the past and take a look at that and how important is that. So that's the very first level you want to mark. Okay, and my system does do that automatically for me. I know you can also look for that with your own platform if you use NinjaTrader. I don't know if I'm gonna have this for selling or not yet, but if you contact me, maybe I can, and I'm willing to share the whole template. If you have the indicators that I'm using, that can help you out. If you follow this method to the letter, you will see how powerful it is. Okay, so after establishing the regular open price level and mark, the second thing you want to note or mark is your swing, opening swing high and opening swing low. Okay, so that here it's marked by the IB high and the IB low, but those are for the swings. Since I cannot change that that tags, I should say, without going into the code, which maybe I would do it, but I have done it right now. So, but those are for the first 10 minutes. So you want to know that. That's the opening swing high and opening swing low, what I call. And those are for the first 10 minutes. Okay, so 10 minutes after you have your first 10 minutes, which is that square right there between 8:30 and 8:40 central, you have your swing high and your swing low. Okay, so the swing high has been established right there, as you can see, and the swing open and swing low is established right there. Okay, by this moment, I'm certain that you have identified how important is that level in price. Okay, so that's how we want to do it. So just to go and recap a little bit before going into more stuff. First thing we want to do is to establish the opening price, and that should be as a level. Then we want to establish the opening swing high and opening swing low. Okay, and after that, we don't want to trade for the first 10 minutes. Okay, so the very first 10 minutes trading is not allowed. And as you can see here, trading is not allowed. And also I have that image there, that legend there, that indicator that is telling me no trading, just watch from 8:30 to 8:40 central. And why we want to do that? Well, first of all, we want to really establish and see what the market wants to do. You cannot go right into the open without knowing exactly what's happening. You want the market to show you what's the move, and if you're clear about that, then after 10 minutes you are clear to start trading, having a very certain direction of the market and where it wants to go. So of course the market can do whatever it wants, but what I'm saying is that you have a mechanical way to do things, and that's what is going to help you in the long term. If you just come in here without a step-by-step method to approach your trading, what's going to happen is that you're going to trade without any direction, any method, any steps, and that's going to turn your account into a losing account, a loser account. Okay, so and we don't want that, and I don't want that for you too. I've been there in the past and I know how that feels. Then you start putting money into your account and it never ends. Okay, so first thing, mark your regular open price or your opening price. Second thing, mark your swing high and your swing low for the opening. That's for the first 10 minutes after the open. So that would mean 8:30 to 8:40 Central Time. Then you don't want to trade the first 10 minutes after the market opens. Okay, you want to establish how and what the market wants to do, what direction, which are the levels to be established. Also, your swing high, opening swing high and low, they are going to be established in the first 10 minutes. So you're not going to have those levels set and fixed until the first 10 minutes after the open have gone up. So there we have our first 3 steps right there. Your opening price, your opening swing high and opening swing low. Then we have to understand if the price is near the VWAP, which is that white dotted line right there. This one here, I hope you can see it. This right here, it's the VWAP right there, VWAP. Okay, so that's going to help you out, letting you know if the price is below or above the VWAP. And after the first 10 minutes, you will see if prices are meddling around that VWAP or they are being established below or above. And then your midpoint. Your midpoint is that line right there. It's also a white line. It is a straight line almost, not too much curvy, but it's this line here. That's your midpoint. Your midpoint will let you know your barriers. Okay, if we're below or above, also that's gonna help you out with your direction and where the market is going, and when it's gonna turn back up. Or it's going to reverse, you will be certain that the price will try to go to the mid-level or midline and the VWAP. Okay, that's called mean reversing. So, and then the last one is this like cyan or I don't know, blue dotted line. That's the simple moving average 200. Okay, that's 200 simple moving average SMA. Okay, and that's there because there are lots of traders around the markets that take a look at that line, that moving average. Okay, after that's been established, of course you want your levels for the prior day. That's going to be the high of day, the prior high of day, prior low of day, also the value area high for the prior session, value area low for the prior session. That's what you see here in these levels right there. I hope you can see it, but it's right here. This was the value area high for the prior session, and this was the value area low for the prior session right there. Okay, as you can see, that lines is also, those lines are also marked in the chart. Okay, and then we're gonna have a lot of more levels that are going to be marked. If they are naked, that means that if they are rolled over from the prior session without being touched, so they are going to appear there in your chart. If you're using these indicators, which I'm using, and if you drop me an email, and it's going to be in the video description, we can get in touch and see what happens. Okay, now last levels that happens after 1 hour, that's the initial balance high and initial balance low. Those are very important also. As you can see, that's IB low, and then you have here that yellow IB high. That's your initial balance high and your initial balance low. Okay, for the first hour, which is the standard for the market. This is standard for the first hour. You want your high and low. Okay, those levers are going to be revisited, and also those levels will let us know if we're gonna have a very strong move in the price, or if we have a wide opening initial balance, or range. So yeah, it's a lot of things happening around those levels. Okay, now how do we decide if we're going long or short? First of all, the bias. We don't want to be biased. Okay, price can go down or up, whatever the market wants to do, it's gonna do it. We have to be prepared to understand if the market wants to go down or up, if it's going up or down. We have to be ready to get into that train and grab our money into it, into our bank account. Okay, so that's what I'm talking about. Yeah, to understand all this together, we don't want to know. No, I mean, the market can do whatever it wants. It can go up or down. We have to be ready to be with the market. Okay. So after we have established all that levels, that is not going to be you. It's the indicators that we are using. They are all right here. Okay. They are all right there. Right. Yeah. Then we are going to understand how to manage our trading. If you're using a 2,000 account or a 3,000 or 5,000 account, it doesn't matter if it's $2,000 or $10,000. What we recommend, I've seen that this is the most common amount for the retail traders accounts. So that's gonna be $2,500 account. What we recommend is not to use more than 5% of your account. So 5% of your account is gonna be $125. Okay, $125. You don't want to be risking per trade more than $125, right? So this is going to be a rule, and I hope you can understand that without rules, this game of trading is not going to be profitable in the long term for you if you do not follow these rules. Okay, so let's say you have a 5,000 account. You don't want to risk more than 5% of your account. That's going to be 250, right? 250 per trade. You are not allowed to risk more than that. Okay, so if you risk more than 250, you are putting yourself into a position that will drag your account pretty fast to the negative. Okay, so first rule, do not risk more than 5% per trade of your account. And I'm certain you can do that. I have shown you 2 examples on how to determine that, and then you have to set that on your trading platform as a stop loss. Okay, so now that's for the stop loss and risk no more than 5% of your account. No risking per trade more than 5% of your account. Please do that. Now, what about targets? Okay, if you want to be profitable in the long term, you have to have your targets at least 3 times your risk. Okay, so if you are risking 5% on a $5,000 account, which is $250, you are looking to make as your targets at least 3 times 250, which is gonna be $750. Okay, per trade. Okay, so that means that if you have 3 losing trades in a row, and then you have your 4th trade that fourth trade is going to recover all that losses you had in the first three trades. Okay, and this is counting that you already know the method of how to get in and out of this market. And I'm using NASDAQ because that's the baby that I use to make some dollars into the market and put it into my bank account. Okay, so again, if you have a 2500 account and you're risking 5%, that's going to be 125. Your target should be 3 times your risk, so that's going to be 375. And as soon as you have your money in your account, please stop trading. That's money preservation. Okay, so I have this indicator here that helped me out with that. Okay, that's a risk and reward indicator. I can give you all the specifics there if you drop me an email. And let's say that we went long on this level there. So my risk, let's say I want to risk $250 there, 250. Okay, so those $250 should yield $750 as 3 times my risk. Okay, but then you have 1 time, 2 times, and then 3 times your risk. What you have to do, and this is the key here, what you have to do is as soon as you get in there, this is what you have to do. As soon as you get in there, like for example at 87.95, even you get in long there, you establish your stop loss right here to $150. Then your first risk to reward, your one level, it's going to be 250 right at that price, 88.0750. As soon as you hit that price, you move your stop loss to break even. That's how you're protecting your money. If you don't do that, it's going to be painful. Okay, as soon as you hit your second target, which is going to be 2 times your risk, that's going to be $500. Okay, and that's 88.19, or let's say 88.20, and let's see what's the high there. The high was 88.20.25, so prices went to that level there. As soon as you hit that 2 times your risk, you want to move your stop loss to your first target. Okay, to your first to 1-to-1. I shouldn't be saying target, but I should be saying 1-to-1. This is 1-to-1, this is 2-to-1, and this is 3-to-1. Okay, and then prices stall there and reversed and stop you out, making 1-to-1. But at least you make some money, and the most important thing is you didn't lose money. Okay, that's more important than to make money. You don't want to lose it. We are here for capital preservation. Okay, that's our goal. Second goal is to make money, but first goal is capital preservation, meaning preserving your capital to be alive longer, to hit a home run, right? So I use $150 as a risk per contract. Okay, so for me, I trade several contracts, but I don't risk more than $150 per contract. Okay, so that put me there. I don't risk no more than $150 per contract. So that means that if I do trade 3, 4, 5 contracts, I'm not risking more than $150 per contract. Then you time that per your contract, okay? That's the best thing to do. $150 per contract, trading 5 contracts, that's gonna be $750 times 3. That's gonna be $2,250. Have I reached that? If I have took this trade entering this bib level, yes, I have. Why? Because I'm risking just 150 here, and 3 times that 150, meaning 3 to 1, it's just 90 ticks. I'm risking 30 ticks to make 90 ticks, and then I reach those 90 ticks pretty fast, as you can see here. I hope you can see it. I hope you can see it. It's right here. Price really touched that level, as you can see there. Okay, so I would recommend you to do that same thing, right? If you have a 10,000 account, very good for you. If you have $25,000 in your account, that's awesome. If you have $50,000 in your account, I can tell, well, that's a good thing. I've been there. I do not have more than 25,000 in my account for a reason. And that reason is that when you have lots of money in your account, that makes you sloppy. So I take money out and put it in my bank account, and then if I need some money, I put it back in, whatever. What I'm telling here is that I'm not risking more than $150 per contract per trade, okay? And then I had my 1-to-1, that's 30 ticks. I reached that right here, and then as soon as I touched that level, I moved automatically, my stop loss moved to break even. Then as soon as the price went to 2-to-1, that's 60 ticks, we went down a little bit, as you can see there, low 88.02, and the stop loss was 88.0250. Something is not right there. Let me check. Yeah, 88.02, and price was 88.0250. So we were stopped out there, okay, with $150 in our account. But that's up to you. This candle here didn't close above that 2 times my risk. So my ATM is set that when this is closing above that level, my stop loss is gonna be moved. So in this case, I went and continued with the trade, hypothetically, and as soon as I touch the 3-to-1 risk to reward, that's 90 ticks. If I wouldn't have, I will have some runner, my stop loss would be moved to the 2-to-1, okay, so to the 60 ticks. So that's how I protect my money. What I'm showing you here is, you would be wondering, I thought you would show us how to enter and what's the method. And yes, I will show you that, but most importantly is how to manage your trade when you are in. So I hope that's clear for you, my explanation. So once again, you want to go short or long, whatever, in risk, in my case, no more than $150 per contract per trade. Okay, that's my $150 right there. Okay, that's my $150. And then I have here my my 1-to-1. It's right there. Yeah, Here's my 1-to-1, here's my 2-to-1, and here's my 3-to-1. As you can see, 150 on risk, and to make $455 every time the prices move fast, we're gonna reach that. So you're risking 1 to make 3. That's good. That's gonna help you out with your trading. You're gonna grow your account faster, even though if you're wrong 75% of the time. So that's important. Now to the method. Okay, now to the method. We are going to use in this method the levels which I mentioned before. Now I'll show you how to use channels, trend lines, and Pitchfork. Let's start with channels. Okay, channels, I would recommend if you use NinjaTrader to use your snap mode to bar and price. Okay, that's very helpful. Channels are made, channels help us out to understand where the price is going. Okay, and then my price is going here. I have established this line here. That's the first 10 minutes which we're not trading. We are not trading those first 10 minutes. We have this swing high, which is the opening swing high. With this we have this lower swing high, then we have this swing low, and that's how we made our channel, our 10-minute swing channel. Okay, as soon as we have that ready, we want to wait. Okay, well, you can draw that as soon as you have that, since you had that information to 8:34. You already had that, let's say 8:36, 8:37, whatever. You already have this level here, and also since you already have your level, it's very easy to then adjust that if you only have this level here and this level here, those two pivots. Okay, you can draw your channel just using that, but that's another lesson. Okay, so as soon as you establish your channel, what we want to do, since we're going lower, we are below the opening price, and prices are leaving the VWAP and the midpoint to the downside. What we want to do is test lock. that's what I do. I don't do anything else. Okay, that's what I call it, test lock. How's that? How much are you gonna risk with your test lock? $150 per contract per trade. That's what you're risking. And if you have a $3,000 account or $5,000 account, $150 really, if you are using just one contract in a $5,000 account, if I divide $150 account, $150 by $5,000, that's just 3%. So you're not risking too much. You're risking 3%, and we're allowed to risk 5% of our account. You are allowed to risk to 150. Okay. Very interesting. Very interesting. Okay. Continuing with the channel, we want to test lock here, going short this level. Okay, between this swing and in this test here, we have 2 minutes, so you have to be there. Okay, you have to be there. And if you think you missed it, then normally prices come and then come back up. Okay. Yeah, so normally prices, what they do is they start to drift lower, and then they go back and test your level, and then they start going down. That's what normally happens. If you think that you missed that, and if you can see, you see this price here is 88.20, and let's see what was the high there. The high was 88.20, so you can fade that also. So anyways, you test lock here. You test lock right at the cross of that channel, or at the cross of that level, the initial swing low. Probably I would have gone and I would have set my pending order right at the test of the channel, right there. You see that price went up to test that channel. Okay, so let's try that. If we use our indicator to risk reward, we got in there. We want to risk $150 there per contract per trade, and you started your trade right there, right where it says sell 88.18. It's gonna be 75 probably, or 19.25, yeah, whatever. Then your trade starts to go your way. 1-to-1 hit, price move to entry, then 2-to-1 hit, price move to 1-to-1. Now at this point you're making money already, and then price touches your 3-to-1. That's 450 per contract right there. So what was our entry? Our entry was because we said we want to go here and establish our channel, going this way and then going that way, and we want to go and test lock as the price breaks down that lower channel and comes to test it. Do not be afraid, as you can see there. Do not be afraid, because you will be able to put your stop loss right there, 150. The price has to go all the way to the mean almost, meaning VWAP and midpoint, to stop you out, and it's just $150. So test lock, don't be afraid. Okay, so that's using channels. That's using channels. Okay, now let me show you using trend lines. Okay, using trend lines. Okay, using trend lines. How do we draw our trend lines? Well, I have my own method, and I'm not sure if that's gonna work for you, but trend lines are very interesting. Here we have our fractals swings, or our swing points. That's marked with the dot in the price right there. We have this dot here and this dot here. Okay, but then I had that dot there, so it's not valid. Okay, so I draw again. I connect these two dots right here, and at that point I connected that dot right there. I'm expecting the price to break that and go back up. Okay, so that's gonna be a riskier one, but I would have get in at the break of that trend line. That's gonna be let's say right there, and we're gonna risk $150 per contract per trade right here. So we would have gone long at that price, 87.89 even, and then we would have this drawback, this move down all the way to 87.84.50 or 25, but we're safe because we're risking 150 to make 455. After that, price goes back up, and what for me it's very important, it's to look for the volume. and I didn't sell that much selling volume there. Okay, as we were going up and then down, the volume is not that strong. So not like this one here, very strong volume down. But then we don't have any selling volume, and then we reversed, and as soon as we reversed, we started to grow with volume, and price went back up. So that's trend line, and you will see that it's very useful when you want to trade this levels here. I'm sorry, like that. Let's say you want to go short, that's your first, that didn't work out, this price still continued going up. Okay, and then you connect these two, they didn't. Then you connect this two, and that was broken to the lower side. Then you want to wait and establish your entry, and your 150 is going to be right there. That's where your 150 is, your stop loss is set. Your entry is right here. First target touch right there, but not closed. So stop loss remains here, goes back up a little, but then look at this, 200 SMA, VWAP right there, perfect spot to ride this market. Then as soon as we close below that 1-to-1, stop loss is moved to break even. So now you are in a free trade ride, and you don't have anything to lose. Okay, then prices go and touch your 2-to-1, and then reverses. As soon as you touch your 2-to-1, this stop loss is moved. If it closed below, if not, it's gonna go all the way back. You are protected right here to break even, and then prices reverses and goes all the way to where? To your target, 455. Okay, that's trend line, and that's why I use this swing, this pivots. Okay, those are the pivots. Now remember, channels, trend lines, and pitchforks, right? I would have drawn my pitchfork probably here to here and here. Okay, what it's telling me, as if you study pitchforks, which I'm gonna make a new video about this pitchfork, is that if prices fail to go and touch the midline, then we're gonna have a strong move down in the opposite side. And right here is exactly what happened. Okay, it's exactly what happens right there. Price tries to go back up, but it never went to the midline, which is this line here. Okay, it never went to that midline. It stayed short. More important than that is price went to the midline and went to the VWAP, and that combination of VWAP and midpoint, it's so strong that it's going to be rejected for sure. Okay, so you have to be ready, and trade right there. A reversal is too risky for me. It's too risky. But if you have made $1,000 in the day, risking 150 here per contract, it shouldn't be a problem. But anyways, I wouldn't do that. I would expect the price to go in the opposite direction. Okay, and to do what? To do what? To break my lower line of my pitchfork. And as soon as that happens, I position myself right at the break of that. I'm gonna risk 150 okay, dollars per contract. I'm gonna get in right there, and if that's breaking, remember, we're testing luck. What's wrong with that? That's what happens with traders. Traders are afraid to get in. That's FOMO, fear of missing out, okay, or fear of entry. Then that's trading paralysis. So you get in there, you're risking 150. What's if you're risking 150 and you lose it. That's it. If you're following the logic here, you're gonna make money more times than not, and all the times you're gonna be protected. So don't worry, get into the trade, okay? Trust your method. So price went broke in that level there of the Pitchfork we drew, and as soon as we do that, after we have, remember, we draw our Pitchfork using these three pivots, okay? 87 80, 88 88 20 25, 87 97, I'm sorry, 88 87 87 even. So as the price went up, we are expecting two things: or the price goes to the midline and then it's rejected, or if the price is not able to go to the midline, it's gonna be a very strong move in the opposite direction. That's what you have to master. So we get in there, okay, short. As soon as we see the price going down, we set our pending order to short right there, and then we leave it there and we wait. Then the price goes to our 1-to-1. As soon as that's closing below that 1-to-1, stop loss is moved to break even. So you are again in a free trade, right? Then prices go to our 2-to-1 right there. And what's that level? What's that level? That level right there is initial balance low. That's the low of the first hour of trading, okay? Prices went down and break, okay, and then our stop loss is moved as soon as it closed below that 2-to-1. Stop loss is moved to 1-to-1. So we're making money here. It doesn't matter what happens, and if this thing reverses, we're making money, and it ends up touching our target. So we again made our $445 per contract, risking $150 per contract. So that's using your pitchforks. Now let's draw this pitchfork from this high to this low here to this high here, okay? Look what happens. I'm gonna turn this into shift, okay? Let's see if no, okay, let's go to standard. That's fine. But prices went crossing that midline, okay, and went all the way to that zone there and then reversed back. That's what I wanted to show you. But anyways, also we have this pitchfork possible to draw here from this high to this low to this high, okay? And here I'm gonna turn this into a shift. Okay, take a look at that. It moved from this high to the mid, okay? Then price went down to touch the mid level. It turned back up. It never went to this level here. So then crossed back down and almost went to touch that one and then reversed, okay? So important thing there, you can draw your pitchforks and have your swings helping you out to draw your pitchforks. That's very important. Also, we can turn this into a shift, modified shift, okay? And I wanted to turn that into a shift to show you that we have drawn this pitchfork using this swing here this swing here and this swing here. Okay, now when price goes back up, take a look at where it stalls, right in the midline. Okay, right in the midline. So that's the beauty of Pitchfork, and I can draw a standard Pitchfork using the same levels. See that? So you can draw your chef and your standard Pitchforks to help you out with this, and to be certain that we're not able to reach that midline. And with the shift, we were rejected because we have confluence right there with the midpoint, the BWAP, and the mid of the shift Pitchfork, and then it went down. Okay, market's open and it's going there. So let me remove all these drawings and go back a little to show you one more example. Maybe we can find that. This is very boring day. This was the 20th. Okay, that's why we wait. Let's see here. This is the price opening price right there. Prices go down, then go back up, go down, back up. We are in the no trading zone. Okay, we are in the first 10 minutes of no trading. So we establish our opening swing high, and we establish our opening swing low. Okay, then price is trying to go lower and establish the initial balance low, and then price go back up, right? So how do we approach this? Okay, first of all, we have our channel. Okay, we have this channel here that we could use. This swing high here, this opening swing high there, this swing low, and then we have our channel. And what's happening with the channel? Well, number one, we have the price going to test that lower line of that channel that is projected from this swing low. Okay, and it's tested again, right? That swing opening swing low it's been tested here, and then it's rejected and goes back up. So what you're trying to do here is to establish where the price wants to go. Okay, if you break your midpoint BWAP to the upside, you're certain that you're going to test your regular or opening price. Okay, because they are building positions right there. Also, your short volume is not that much, so you are certain you can go there. Okay, at this point you have two opportunities. The first one is when price breaks this level here. Okay, the second one is if we project a pitchfork using these two swings and this swing low, okay, and turning this into a shift. There you have it. I'm going to erase this channel. Okay, once again, price did not touch the mid level. It went back up, and remember that if the price do not touch the mid level of the pitchfork, you are going with a very strong move to the opposite side, which it happens. Okay, went all the way there. So that's your second opportunity. If you didn't go long with that channel, you can go long there. Okay, I could say that we could have used this swing here to this swing and go short there, and that's true, but we are in the no trading zone. Okay, so we're not trading at that moment. Okay, then we had this swing and this swing here and so we can go long there also. Okay, and be very careful, because if you set your risks to reward to that zone, that's 150, is going to be down here. Okay, so you didn't close there, so you have your stop loss down here yet, and then go back up, no, closing there, moving your stop loss to break even, and then you slowly build your position. So that's a very slow example, because it was a slow day, but how to use your Pitchfork, your channel, your trend lines. Okay, let's go back and see if we can find another one. Yeah, this one here. Okay, opening price right there, price went back up. It's very certain that we are going higher this day, because we didn't stay too much below that opening price. We went straight up right at the open. Swing, opening, swing high, opening, swing low. First 10 minutes no trading. We have been shown the market wants to go higher. As soon as that happens, you start analyzing your market. Swing high, trend line. Okay, break of that trend line, you have your trade. You set your trade right there, $150 per contract per trade. Okay, and there we go. That's one option. Okay, second option, Pitchforks. Let's test that Pitchfork. I'm not sure. Yeah, Pitchforks. This case is not too clear to trade with Pitchforks. Let's try Chef. Yeah, it is not. So Pitchfork wouldn't work this time, but trend lines would do. Also, you can try to go along these levels. Okay, this was the opening swing high, and now here has been challenged, but we are above the VWAP in the midpoint and the 200 SMA, and above the regular open. Okay, so second opportunity is to go this opening swing high and establish your $150 per contract of risk per trade, and then manage your trading. Okay, manage your trade. As you can see here, there is no selling volume, only buying volume, so you are safe. You're safe right there. So first opportunity, break of that trend line. Second opportunity, break of that opening swing high. Third opportunity would be break of that opening, that initial balance high. Okay, that's over at 930. See that yellow line? So the second opportunity is to go long at the break of that opening swing high. I'm sorry, of that initial balance, which is that level there, and set your 150, which is going to be there, right there, and then manage your trade, right? So you had 3 opportunities this day to go, and that's not December 19th. So yeah, so that's the method, and we're using just one chart with all these indicators. If you have any questions, or if you want some help, or if you want some guidance, please reach to me, and we'll see what we can do. But this is the method that I'm using for a while, a combination of a couple of methods, and turning these into a very easy trading method to use on 2020. So I hope this helped you in some ways, and if you have any question, please let me know. Drop an email there, and we'll be in touch. Okay, this is the market opening on the 29th of December. It's challenging this wave down. And also, if we draw our pitchforks, we are going up. Let's draw this other pitchfork. See the downside, we broke that level right there. And trend lines and or channel, it's right there, it's been broken. So I hope this helps someone there. So okay, JD out. Thank you.